Tax tips. No one here in America likes paying taxes and having Uncle Sam take away their hard earned money. However, taxes are a mandatory part of being an American citizen, unless you're exempt from tax. This video will tell you a few ways of how you can pay less tax on your investment and investment costs. This is not a video on how to evade tax, however, how to legally ensure you aren't paying as much tax as you previously would have been. Despite the fact the majority of tax depends on your personal situation, there are a few simple tax tips that apply to most investors which can help you save money. So tip number 1 is dividends. Reinvested dividends increase your investment in a fund or a company and thus reduce your taxable gain or increase your capital loss. While the reduction in taxable income may not be very significant in smaller investments, failing to take advantage of this rule could cost you significantly in the long run. Keep accurate records of your reinvested dividends and review the tax rules applicable to your situation every time tax season comes around. So generally, you should be planning your taxes on about March 15th, so that's a month before your taxes need to be in. So ensure that you do keep accurate records of your reinvested dividends and ensure that all of your records are kept in a reasonable order so that you can refer to them easily when tax season does come around. So tax tip number 2 is bonds. When stock markets underperform, investors make the flight to quality and look elsewhere for good investments, of which bonds are the most popular type. Real estate is also very popular, however, we don't have a tax tip for that at the current moment. So when calculating your taxes, remember to report the interest income from bonds on your tax return, as you may not have to pay tax on all the interest you received. If you bought the bond between interest periods, you normally will not pay tax on the interest accrued prior to your purchase. You must still report the entire amount of interest you received, however, you will be able to subtract the accrued amount on a separate line. So, short-term government bonds are a convenient safe harbour for your money when the equity markets are not robust. And short-term government bonds, especially United States Treasury bonds, are incredibly popular investment entities in the United States and globally for that matter. So, if the stock markets are underperforming, consider investing in bonds and save that extra penny on taxes. Did you purchase a new computer last year? If so, you can possibly write off a portion of the cost if you use the computer to place trades or to help manage your portfolio. This is tax tip number 3, write-offs. The portion of the computer's cost that is deductible depends on how much you use the computer to monitor your investments. For example, if you paid $1,000 for a computer and you use it to monitor your investments 20% of the time, $200 of the computer's cost is eligible to be written off as a business expense. If you've invested in small business ventures or are self-employed, there are many expenses of which can be written off. For example, if you take any business trips during the year that require accommodation, the cost of your living quarters and meals can be written off as a business expense within specified limits depending on where you travel. So ensure that anything which is classed as a business expense is written off as a business expense in your taxes, and this can save you a significant amount of money if you buy large assets for your business, which you accidentally declare as personal assets. Tax tip number 4 is tax deferred programs. Every time you make a trade for a stock, you're vulnerable to capital gains tax. Making your purchases for a tax deferred account can save you a pile of money. Tax deferred accounts come in many shapes and sizes, with the most well known being the individual retirement accounts, or the IRA, and simplified employment pension plans, which are SEPs. The basic concept is that you're not taxed on the funds until you withdraw, at which point you are taxed at the rate of your personal income bracket. Waiting to cash in until after you retire will be even more, as your income will likely be lower when you're no longer earning a steady income and are employed. Moving on to tax tip number 5, brokerage fees. Now, as you know, buying stocks isn't free. For the most part, you will pay commissions unless you're using Robinhood, Trading212, etc., etc. And you may also pay transferring fees if you change brokerages. These expenses should be added to the amount you paid to buy a stock when determining your cost basis. When you sell shares, subtract the commission from the sales size or the sale price of the stocks. So all of your commissions, your additional fees, and if you've done broker assisted online trading, that's with TD Ameritrade, that's $44 you can write off with broker fees already. So you can save a large amount of money, especially if you do use a real stockbroker as opposed to just an online brokerage. These costs are similar to a write off, as they are direct expenses incurred to help you make your money grow. After all, brokerage fees and transaction costs represent money that comes straight out of your pocket as an expense incurred while undertaking an investment. So, this tax tip doesn't help you save a dime or even a dollar. It can help you save hundreds or even thousands of dollars per month. So, tax tip number 6 out of 6 is holding on to stocks. As you know, the buy and hold strategy is great for a number of reasons, and short term capital gains being taxed at a higher rate than long term ones is a key reason. The difference between tax rates of short term and long term investments can be 13% or more in some states and countries. And when you consider the long term effects of compounding on reduced income taxes incurred today, it can prove very useful to hold on to your stocks for more than a year. So, if you are a technical analyst and if you are, you generally sell or buy a position within a day of buying or selling it, then you are going to be charged a significant amount of money in capital gains tax, short term capital gains tax. However, if you hold on to your stock for more than a year, that's considered a long term investment and your capital gains tax is reduced significantly, which is just a better argument for growth investing. Now, to summarise, there are hundreds of intricacies when it comes to tax laws, and part of a successful financial plan and investing plan is great tax management, ensuring that you are actively taking advantage of tax avoidance opportunities that apply to your situation, and also ensure you do not overlook any expenses or income reduction techniques that you can use to reduce your taxable earnings. Now remember, this video is not teaching you how to evade tax, however, how to legally avoid paying as much tax as you would have been. So these have been 6 key tax tips which you can use when investing to save a significant amount of money.